Hi, it's Nash from Alpha Phi, and today we're going to look at health rating and performance on policies for different health ratings, as well as discuss an interesting topic about upgrading your health rating after your policy is in force. If something happens and you want to get a policy in place, but something is holding you back from a higher rating, there is an option later after your first policy anniversary date to actually get a reassessment and have the opportunity to increase your health rating. And not only does this allow you to have better efficiency going forward because those insurance costs will be less, but they also will go back and act as if your policy was always at that higher health rating, essentially giving you credit back for cash value and death benefit. So I thought this was really powerful and an interesting thing to be aware of to share with you all today. So I'm going to dive in. So first off, talking about health ratings and the impact to performance. Why is health ratings important when looking at whole life insurance? Well, it is life insurance, even though we're using them to access the cash value, perhaps redeploy those into other cash flowing assets. But the underwriting teams at these major companies and the qualification when looking at giving somebody a policy is to a certain death benefit amount. And they are also looking at assessing your health depending on how big of a policy you want to take out, meaning how much death benefit. They may have more and more requirements. So for example, if you're looking for, if you're young, say 30s, a couple $100,000 in death benefit, really they're not going to require too much. But if you're in your say 50s looking for 10 million in death benefit, there's going to be a lot of things they want to go through to really understand the risk they're taking on in insuring your life, frankly. So that's what they'd look at when underwriting, looking at your health and your records, as well as the amount that you're requesting. And so the health rating can have a certain degree of impact, and it's quite important to understand. Even when looking at high cash value designed policies, which is really just traditional whole life with specific design elements to them, you want to look at design, the company selection, and the health rating has an impact and is important to understand. It's not as big as you would think, but it is important to be aware of. The different companies have different health ratings. This is the terminology of one of the four major mutual companies. They have the highest health rating, preferred plus, then preferred, then standard, and what they call the rated table, which is some sort of, it's on the lower side and will go down rating 1, 3, 6, all the way through 12 for different health concerns or conditions in which they'll essentially increase the cost of insurance because of those risk factors when looking at somebody's health. So, can you upgrade a health rating? Yes, you certainly can, as I shared before, and you can do so as soon as after your first policy anniversary date. And it doesn't only upgrade your health looking forward, it actually retroactively applies that health rating as if you've had it from the day you opened the policy. That's really cool. So say you went 10 years at a lower health rating, and then you ask for a reassessment, they'll actually apply it to those first 10 years as if you've always had that upgraded health rating if they decide that yes, you do receive that. Can you make your rating worse during doing one of these assessments? No. It can only be improved and will not be downgraded after starting a policy. So that's nice. There isn't much of a downside other than probably a little bit of time commitment in putting in this application. And some examples of when folks might want to actually take a look at this is, say, weight loss, or you've been cancer-free and it's been a very long time and haven't had any issues, or occupation change. For example, you had a really high-risk occupation, and now you're no longer in a high-risk occupation. All these things essentially taking the circumstance that was of concern and now it's removed from your life, or it's been under control for a very long time. That can be an example of some of the reasons or some of the examples of what may constitute a upgrading of a health rating that people can consider. I'm having kids right now and sleepless nights, certainly not working out as much. So my weight isn't where it used to be. And so, that could be something going on in your life that is not going to be a forever thing. I certainly want to get back on the wagon there and get back in really good shape. So, these kinds of things come and go throughout our lives and is worth being aware of. And then lastly, kids policies. Kids policies are a little different. They actually will always give a juvenile, meaning under 18, a standard health rating, at least. And they can't get the higher health ratings, but what they can do is when they do become an adult and turn 18, they can get reassessment of health and actually upgrade it to a higher rating. Because of the kids policies, they're a little bit unique in that they won't go back and reapply that upgraded health to the past, but going forward, it's a really good thing to do. If you do have kids policies, they always start them at least standard, and you can upgrade them a few tiers, which is a really, really good thing to do. Okay, I'm going to go through some examples now. So what I did was take a Guardian L95 product, a 45-year-old male health comparison with a policy design of $100,000 maximum for 10 years, and then do what's called a reduced paid up. The reduced paid up essentially means after year 10, in year 11, we're going to make an election that says, I don't want to pay any more into this policy. Basically, the policy becomes paid up. And so we tell the company we're not going to pay any more premiums, and they actually will reduce the death benefit because we're not going to make any more of those premium payments, because how they work it is they amortize it from start of policy until you're age 95 in this case. That's why the product is called an L95. And so since we're not making those further payments, they're going to reduce the death benefit because we're not finishing it off, and no more payments can or need to be made into the policy. So that is the design that we're looking at here. Then over the top here have preferred plus or highest health, preferred, next highest health, standard non-smoker, and then rated class 1. So those are the different health ratings, and I've got all the detailed numbers here, and then we'll look at it in a chart. But what we have here is, across the top, the policy year, the age, so 45-year-old starting and increasing each year, the minimum payment, and you'll notice that the minimum payment will change because the whole life base premium is the same. It's 90, 90, 91, which is the lowest I can go with this particular company, Guardian. The difference, though, is the amount of term rider we're paying for, essentially, from policy to policy, which is also considered part of your minimum payment. Then the target payment, or the maximum, we can put in each year. So this is the minimum bumper on our bowling ball alley of our policy, and our target max payment, which all of the rest of that, 10,000 minimum, really going to base policy premium and life insurance, and the extra 90,000 or so dollars going into paid up additions or into the cash dump side of the policy, as some people refer to it as. And then the cumulative outlay or out of pocket, so 100,000 every year is building up here to $1 million total out of pocket, or 100,000 for 10 years. And then we're showing the dividend scale here, so the cash value and the death benefit of the policy, the annual IRR, so are we gaining or losing money every year? You'll notice in the first year, we take our biggest hit with these policies, and then every year thereafter, it gets better and better. And then in the last column here is just the percentage of money coming back to cash value in year 1. With this product, you'll normally see this in the high cash value designs between 80 and 90% in year 1, and then again every year thereafter it gets better. And then down here is you'll start seeing these numbers pop up. It's the cash value year over year growth, not including what you're putting into the policy, but just the essentially dollar figure of this rate of return. So the highlighted portion here is showing the break-even point. So in year 5, we put in $100,000 for 5 years, $500,000 out of pocket, and we have $500,170 in cash value. And then it continues to grow from there, and from year 11 on, $0 going into the policy out of our pocket. So all of this is just growth from the policy itself. All right, that is the layout. So keep an eye on a few things here. The minimum payments, as we look at the other health options. The minimum payments, the net cash value, the break-even points, the IRR comparison here, and the year-over-year growth of the cash value. So let's say age 60, just to hone in on something as we scroll over here. So first thing we'll notice is that the minimum payment is jumping up some, and also our break-even is spilling over into year 6, not cleanly in year 5. It's between year 5 and 6, and then the IRR is essentially 0.1% less as we jump from preferred plus to preferred, and you can see the cash value and death benefit differences there, about $10,000 at age 60. As we continue to scroll over, the break-even point jumps a little bit further out here, and the standard non-smoker compared to preferred is about 0.1% less again in IRR, and a little bit more of a hit to cash value and death benefit. And then as we get out here to rated class 1, we also had to drop what's called the enhanced accelerated benefits rider when we went on to the rated table, which is essentially a rider that allows you to access your death benefit early in case you qualify for, or in case you come down with a chronic or terminal illness with qualifying events. I have other videos on that, but on the rated table, we had to drop that. It was not an option that we could go with or add for free, which the others we could. And you'll see that the break-even point's a little bit worse. The IRR and cash values are a little bit worse as well. So I put it all into a chart over here so we don't have to memorize all that. And essentially what we're looking at is the blue line up here is the preferred. This is cash value difference over time, so by age here, and I zoomed it in to age 55 to age 85, just so we're not looking at too much over too long of a time period. And preferred plus is on top, then preferred, then standard, then rated. So you'll see the biggest hit is when we get down to the rated table. The rest are pretty well in line. But if we come out here to mid-70s, let's say, and let's get a little ruler here. And we're going to calibrate our ruler to $500,000 in cash value, right? So we're just lining it up to these lines here. Okay, then we're going to use that. Then we're going to use that to say, well, where are we kind of hitting 500,000 difference in cash value? So we're from preferred plus down to rated at age 77. It's about a $500,000 difference here in cash value. So that's a pretty big difference. The rest you can see down to standards about half of that. So 250,000 in death or cash value. Death benefit would be of similar, probably a slightly larger magnitude. So, you know, let's say you're overweight, that may put you on the rated table, and then you get really in shape, as in my situation, I'm going to become a marathoner in 10 years. Well, this is a giant difference. So a huge, huge opportunity to improve the performance and outcome of your policy. Then we talked about the difference in the minimum payment. And as I said, the whole life base premium was 90, 90, 91 in every situation. So what's the difference then? The difference is because in these policies, this particular design, we're mixing it with 1-year term to raise the death benefit to allow, because that raises the MEC limit, the modified endowment contract limit, or the IRS limit, to allow us to plow in a significant amount of money without triggering any unfavorable taxable consequences. So that allows us to overfund or dump in so much money into the cash value, as some people like to put it. And what I have here in comparison is the rated versus preferred plus 1 year term cost year over year. So this is year 1, 2, down to year 10, and you'll see that actually this is the cost of that, and it's going down each year. And then we have the current cost projections and the guaranteed cost projections. So basically it can't go, the 1 year term cost can't go any higher than these guaranteed values. We've never hit the guaranteed values on 1 year term costs, but this is the guaranteed cost maximum. So you'll notice some things here. It's about, it's about twice as expensive, but it's only $1,000, right? And then as you come out here, it starts to, it comes down over time. And what's going on here in these designs is that we're buying down the term insurance as the whole life goes up. The whole life death benefit goes up. So this is part of the efficiency of these policies that allows us to put in so much money early on, but also over time maximizes the efficiency of the growth. And in here, I just wanted to show the difference in that minimum cost is really because we're blending it with this term. Okay, that was a lot of information, but a really good option to be aware of, especially if you feel like you could have or can in the future go for a higher health rating. It can make a big difference for you and your policy and the growth potential of the cash value and death benefit. And then we talked about the nuts and bolts of what goes on and why the cost difference here. So please let me know if you have any questions or would like to see any examples. I'd love to have any feedback from you. Please like and subscribe, and I'll talk to you soon. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.